Howdy, Jacob here. Today we're looking at Hudson Technologies in the commercial services and supplies industry. Pretty much the same market cap and enterprise value as 640. Let's look at if they have any insider ownership. 13% insider ownership. So pretty good insider ownership for a smaller company, which is definitely what I like. Founded in 1991, so it has been around for a little bit. Growth looks very substantial, 59 million in 2013 to 325 million in 2022, where the most recent 2 years are stupendously amazing growth in ROIC. Margins 40% on the operating margin side, and it was negative gross margin 10 years ago. So it looks like a pretty cyclical business from initial review. Balance sheet has 5 million cash on hand and 43 million short-term and long-term debt. Okay, cash flow statement shows very little capital expenditures. Very little. Wow. Okay. So not a lot of reinvestment through capital expenditures or intangibles. Their use of money recently is just paying down debt. Huh. I would think, if the shares, yeah, that's probably because the shares aren't that cheap, at least to their perspective. So, I wonder why they're not giving more cash to the investor through reinvestment or through repurchasing shares. 175 shareholders equity. Yeah, so that's interesting. I think I'm ready to start making some assumptions here. I'd say just from looking at numbers, it does look somewhat cyclical, and you can see that from this graph too, showing ROIC, where it looks like when it's not even when the world's doing well, because 31% ROIC in 2018, and that's the middle of the financial recession. But I guess 2009 is more so middle. But yeah, I think I'm ready to start making some assumptions. So let's get to it. Let's see what we think is a decent buy price. So I'd say growth right now looks very substantial for no acquisitions and little no reinvestment. And so I'm probably not going to look great here, but the reason I'm doing 0% revenue growth is saying, like, I honestly would not be surprised if it shot down a bit, because the growth was entirely organic, and it seems strange to see 120% growth over 2 years entirely organic in a commercial services and supplies company. They provide solutions to recurring problems within the refrigeration industry. I don't know. I feel like that's too much for me. I'm going to be conservative and say, you know what, maybe it drops quite a bit in the future, but over a 7-year period, I could easily see them come back to this revenue. And then margins have also been very substantial recently, but because it's cyclical, I'll probably go pretty close to an average here. And then on the share change side, probably just stock-based compensation is going to be the only thing bumping this company up. So let's do 1%. Yeah, it was a weird review. This is how I do my initial estimations and assumptions and projections, though. So I'm not going to do deeper dive until it looks obviously cheap to me. And at this point, I'm not convinced by the revenue growing as much as it is currently. And I think, margins are probably pretty close. So I do think that if they had reinvestment capability, or if they did reinvest, they'd have a great amount to reinvest and get money back, but they just haven't done that historically. And so I just think it's a weird business. I wouldn't even say this is a business I absolutely want to own. It's a very strange company that has very little reinvestment, very little share repurchases, to where, as a company with as high of ROIC as them, those are mainly the two things that I'd be looking for. So hopefully you enjoyed the video. Have a great rest of your day. Thank you.